Question 2, Part 4. For the year ended 31st December 2010, it was found that payment to trade supplier totaling 100,000 in 2009 was accounted as employee salary. So this same case as Part 3, but I modified the question to show that this is a different kind of error. Okay. Now, for Part 3, we find that the error occurred in 2010 and we identified the error in the same year. So that will be the adjustment will be at the end of the year. But this is where you are in 2010. This is our current year, 2010, and the error occurred in previous year, which in 2009. Okay, but we detected the error in this year when we prepare the financial statement. So this type of error, we call it as a previous year error. This is previous year error. So again, right? When payment to supplier 100,000 is treated as salary, what happened in that previous year where the error occurred? Your account payable is overstated, and your salary is also overstated. Okay, so now this is what happened in previous year. Okay, not in the current year. This is what happened in the previous year. So when you have made this error in previous year, that means the account payable. Okay, this is SOP item. So account payable that you carry forward to the next accounting period is not correct. Okay, it means that the account payable that you carry forward to the next period is also overstated. Okay, because you have an account payable brought down figure. So when previous year you have overstate, that means the carried forward figure is also overstated. And in 2009 you have overstate your salary because you treat the payment as salary. So the impact of overstatement of the salary, which is expenses, what happened to the SOPL in that 2009? So when your expenses is overstated, that means you have deduct more expenses. Your profit is understated. Okay, can you get that? When your expenses is overstated, that means you deduct more expenses, your net profit become lower. So your SOPL is understated. Now, when we talk about previous year error, you will carry forward to next year is the retained earning. Okay, you don't carry forward the SOPL. Alright, if you remember when you prepare publish account, all net profit goes into the statement of changes in equity, which you write, you add or you less under the retained earning column in your SOCI. Okay, in your SOCI, the net profit or the net loss, okay, is deducted or added into the retained earning column. So that means any SOPL item will affect the SOPL, and therefore this SOPL will affect the retained earning. So when there is a previous year error where we do retrospectively, it means that retro, it is as if that we have corrected the previous year figures. Okay, so how do we correct that? Using the retrospectively method, that is by correcting the retained earning, because retained earning is carried forward from previous year. So when your SOPL is understated, that means your RE is also understated. Okay, so how do we adjust for this one? Okay, so since account payable is overstated, we should less the account payable, and since the RE is understated, we should add the RE. So account payable is liability. When it is decreased, it should be on the debit side. Retained earning is profit. When you need to add it back, it should increase on the credit side. Therefore, the journal entry would be debit account payable and credit retained earning. Okay, so firstly we answer the accounting treatment, right? So how do you answer this one? The error occurred in 2009 is treated as previous year error. Okay, so next, so the adjustment is made retrospectively. Okay, so how do you do the retrospective adjustment? Okay, which means that the error must be adjusted to the opening balance
It's
of
8 o'clock.
retained earnings and account payable. Okay, so the error must be adjusted to the opening balance of retained earnings and account payable. Tak nampak? Okay. So the journal entry. Okay. So you see, for the current year error, you just correct that account. But for the previous year error, we do not adjust the salary account. Okay. Otherwise, if you credit the salary account for the previous year error as if that you are correcting salary for this year, okay, which is wrong. We don't correct salary for this year because salary for this year tak salah. And salah is previous year salary. Okay. So what we do is we credit the retained earnings. So that will be debit account payable, credit, retained earning, 100,000. That's it.